Welcome to the 13th episode of the Sydney Contrarian, titled The Truth About the Australian Economy and Why Living Standards Are Falling. I have been meaning to make this video for some time, but I was busy preparing for my wedding and settling into married life. Things are well now, thank you very much, but please continue to keep us in your prayers. This video is something I've been excited about posting. You know how there seems to be a disconnect between our experience in maintaining our living standards and what we are told by the so-called experts in the government and the financial industry through the media. Many of us can relate to how our income seems to be providing us less, while the cost of housing and basic necessities are rising faster. But we are told in the news and when we read the newspapers that the economy seems to be doing fine and everything seems to be okay and it's all under control, so there's nothing to worry about. Now for younger people, it's even more dire. For them, the newspapers and the media experts, or the experts on the media, keep saying that yes, it is harder for young people to save up to buy their own home in the future. But then at the same time, jobs that they're working in are not paying enough to maintain their way of life, but it's possible only when they are living with their parents. So when there's this massive disconnect between what the media tells us on one end, that our cost of housing is rising faster, and yet at the same time, they also say that for younger people, their jobs are not really paying them enough, and the young people are actually our future. We should be asking ourselves, is this going to continue? And if so, how can we believe that we'll be going for a soft landing when things actually don't turn out the way it is? You may want to think about that again. So what exactly is going on? Let us look at this more closely. So on the 7th of November 2017, the Reserve Bank of Australia decided to keep the 24-hour cash rate on hold at 1.5% per annum. This is the lowest level in history, and it has been unchanged for the whole year. At the same time, they report that the growth of the consumer price index was 1.8% per annum, or the price of goods and services on average has risen 1.8%. You can see that in this figure that over the past 10 years, interest rates have generally been trending down, except for a brief period where they raised interest rates in the hope to spur weak growth in the CPI. However, as they continue to do this, CPI growth continued to fall further, and this time they have decided not to raise interest rates further. The RBA emphasizes the importance of inflation in their monetary policy decision. However, they seem to have very little understanding of how their monetary policy decision is causing weak growth in the price of goods and services, or at least based on their observed measure. The other way to see it is that they may not have a poor understanding of their monetary policy decision in not causing price growth, but they might be actually hiding something in reality. What they're actually not breaking down is the actual goods and services individually, and if you look at how the prices of these are changing, the picture is not flattering at all. Before going into the CPI figures and the economic data, let's look at the general public's perception on living standards. Now, the Reserve Bank of Australia is supposed to try to keep the economy stable through its monetary policy, and its economic outlook is supposed to provide us with a direction on how we should make our decisions, whether we're a business or as individuals. Then we can see how they measure up based on what the general public thinks. Well, they're doing poorly. According to an article published by Macro Business on the 18th of April 2017, titled "Half of Australians Seeing Falling Living Standards," it seems that the general public perceives a negative direction in our society, whether it's in political representation, living standards, and housing affordability. While the most common response in a number of questions is that they expect things to be the same, the overall mood leans towards the negative. The greatest fear is housing affordability and cost of living due to rising prices on the electricity. With living standards, 49% of those surveyed believe it will decline, and almost 1/6 think it will get a lot worse. Now, this article does not agree with the narrative delivered by and large by the lamestream media. They seem to be more focused on rising house prices, stock markets rising, the illusion of low unemployment, which is based on their phony figures, as we have talked about in the earlier episodes. And what they say there is the economy is undergoing a consolidation phase, whatever that is supposed to mean. In other words, if you are feeling the pinch in life, it may be your perception problem. And perhaps you can solve this by going out to buy a new handbag, an iPhone, or flip the channel to watch the next episode of frivolity that includes reality TV shows, Game of Thrones, and other distractions. They're almost incapable of engaging in an honest discussion of why you are experiencing declining living standards where two incomes in a household can barely pay the mortgage, the bills, and have enough left to save up for a rainy day. Let us focus on Sydney and see how living standards may have fallen as a result of the way Sydney-siders have allocated their wealth. From the previous episodes, you have heard me explain how the low interest rate environment artificially created by central banks has led to a significant distortion of the economy and financial markets around the world. And Sydney, in this case, we can see a very clear example. So since 1986, the average property price has risen tenfold, while income has only increased 3.6 times. The difference is made up of a combination of foreign buyers putting in cash into the property market, savings from individuals, and of course a huge amount of debt in the form of banks lending to us in the form of mortgages. The average employee's income is currently $85,000, but a Sydney property is increasing out of reach, being now close to 12 years of annual income, compared to even as recently as 2007, when it was only 8 years of annual income, and that was already very high, and income at that time, on average, was around $60,000. The past 10 years have been seeing what may be the period with the greatest difference between income growth and property growth. And this corresponds to the subprime crisis and its aftermath. What is more alarming is that in the bottom figure where I have compared the growth of property prices and income growth, property price has grown 112%, while income has only grown 41% over the same period. And income growth, I should note, in the past 2 years have actually become slower as well. So while the RBA has recognized that Sydney property prices are growing at a rate to cause concern for them, they have noticed that CPI inflation is weak, and therefore they are reluctant to raise rates in case of deflation. They have completely missed the point, or again, as I said, they're trying to mislead us. The low interest rate environment has led to a misallocation of household income and wealth into properties while constraining one's ability to spend on necessities. Their monetary policy is a failure, and the narrative is wrong. To further the point on why central bank monetary policy is a failure, we should go to the RBA website and look at some of their key economic measures. In particular, check out the 24-hour cash rate, which is the baseline interest rate on savings reflecting what the RBA pays to major banks that deposit their unused cash with them overnight. Also, they report the inflation rate, which is derived from core CPI. The core CPI reflects a variable basket of goods and services reflecting what an average Australian household uses, except these goods and services can change at whim, and certain necessities may even be excluded or underrepresented. The true CPI, which is what the Australian public is actually paying on a day-to-day basis to maintain the living standard, is clearly higher than the 1.8% core CPI reported. The reason why I make this very strong claim, and it looks like I'm not backed by evidence, is because if you actually check how much you're spending this year on petrol, on food, on rent, on electricity, on water, on insurance, on education, it is clearly rising by no less than 2%, and in some cases, in the case of electricity prices, it has gone up 20%. So therefore, 1.8%, you must be kidding me. Even taking these levels already paints a bleak picture. The 24-hour cash rate is 1.5% and is lower than the core CPI 1.8%. Now note that banks pay savers only slightly higher than the 24-hour cash rate on a savings deposit, and is still lower than 2% per annum. In other words, the Australian public is not able to earn a real interest rate of return, or in other words, increasing purchasing power. This has been the case for the past 10 years, especially when we take into account that the true CPI is clearly higher than 2% per annum. This nightmare is compounded when we take into account how much banks are charging on mortgages, being at least 3% per annum higher than what they pay savers on their deposits. What is not shown here is the fact that at less than 3% per annum, compound interest is almost ineffective. But we do not even need to look this way, since we saw in the previous slide the rise in house prices reaching nosebleed levels. People are borrowing more because they do not have enough saved up, and they're throwing themselves into the property market in the bid to earn higher returns to maintain their living standard. This is an exercise in futility for a significant proportion of Australians, as sadly they face a double-edged sword of higher debt while they have weak and even negative wealth accumulation. The core CPI is not an adequate indicator of the cost of living, as they apply weightings on different types of goods and services of which it is not evident to us. Delving further into the data reported in the Australian Bureau of Statistics, we can see roughly how price levels of goods and services across different categories have changed. I've arbitrarily divided the goods and services into basic necessities, services, and discretionary spending. Of course, as I said before, it's arbitrary, so it's not going to be the best indicator. The picture itself is not pretty. Look at the top left figure on the price level of necessities that include housing, furnishings, food and drinks, and clothing, and we see that income has risen 41% over the past 10 years compared to core CPI rising 28.5%. Now, housing comprises, in this case, the price level of properties purchased by first home buyers, and even that has risen 56%, which is double the core CPI, at 15% higher than income. Food and drinks have risen 24% over the same period. Furnishings and clothing have risen much slower, while clothing itself has actually fallen 2.5%. We can see why, because with fashion retailers, they're regularly putting clothes on sale by slashing prices as sharply as 70% in some cases. That's what is keeping prices down. Now, the top right figure includes services such as healthcare, transport, and education. Both healthcare and education have risen higher than income, rising 63% and 59% respectively. Transportation has only risen 9%, perhaps due to the rolling out of the Opal card in 2014 that streamlined costs, although it's slowly on the rise. The rise in healthcare and education costs is alarming, especially because with healthcare, there's an aging population problem and also immigration, whereby our healthcare system is actually under greater burden from people who are immigrating to Australia but have not paid taxes prior to being able to access our benefits. These costs are likely to place more pressure as the Medicare levy will rise further, and private health insurance premiums are going to have to rise as well. Now, the cost of education has risen sharply as well, as universities are charging higher fees and more students are enrolling themselves into universities. Even though I personally think that a lot of the university students who are coming in are not necessarily qualified and will probably not get much out of it when they complete their education program. What is most alarming, of course, is the rise of electricity prices, having risen over 110% over the past 10 years. This does not include a hefty 10% increase since the 1st of July this year, as reported by the ABS, but households are reporting an increase in their bill of 20 to 30%. I cannot stress the importance of this as significant, as electricity prices, they are an important part of society. And this cost of the electricity, which is necessary to running our entire society and of course the world, is placing pressure on people's discretionary income. Based on all this alone, I would argue against the whole green energy initiative, especially the direction that they're heading. Finally, the bottom figure shows the discretionary spending trends. Apart from alcohol and tobacco, which I do consider as discretionary spending, even though some people consider it as a staple in their life, that alcohol and tobacco rises well above income growth and core CPI is a cause for concern. But it's interesting to note that it contrasts with the movements in the price changes of recreation and communication. Now, I include communication in the discretionary spending rather than services because I'm considering mobile phones, even though it's a necessity, to be a luxury, especially when people are changing phones maybe every 6 months. The reason why communication prices are falling is because of competition driving prices down and quick new products coming into the market very quickly. And with the case of recreation prices level falling, it suggests that holidays and leisure, such as going to the movies, going to theatre, and basically the ways of enjoying life, it seems that it's cheaper, so that should be a good thing, right? But the flip side of it is that you could explain households are finding it harder to afford going on holidays as they used to, so therefore as demand falls, so should prices. So if you look at the cost of basic necessities and services rising much faster than income, clearly this also would explain why discretionary spending on luxuries and nice-to-haves have fallen, and therefore prices of these have not risen as much as we had expected them to. We now look at the price levels of discretionary spending over a longer time period, this time from 1989 to the current day. This time I've also included in there furnishings and clothing. I've also marked out the post-subprime crisis period in 2009, when the Australian government under former Prime Minister Kevin Rudd unrolled a massive fiscal stimulus campaign designed to keep Australia out of technical recession by handing out cash to households. The campaign only had a temporary effect, as you can see. The price levels of recreation and furnishings did increase slightly, confirming the view that people did end up spending on holidays and buying household goods, and that stimulated the economy, but for a short while. Clothing and communication price levels have dropped sharply. Now, for the younger generation, this seems to be a good thing, and you can see how often you have young people going to shopping centers and they're coming out with small bags containing electronic gadgets and clothing. However, the sad reality for some of these younger people is that once they move out of their parents' homes and they have to support themselves, they're going to face the harsh reality of that spending on necessities and paying bills being more expensive and rising faster. That's going to eat into their ability to buy these little trinkets and clothing. Finally, I looked into the sales volume of Sydney houses and apartments over the 2003 to 2017 period and compared this with the average Sydney house price. We can see that the prices started rising sharply in 2009. It is also worth noting that sales volume were at a peak in late 2008, quite likely due to a combination of panic selling by those who lost much wealth in the stock market crash, and also as the RBA reduced interest rates, there were some who were able to enter into the market in the hope that they would be able to pick up some bargains. Now, the market started to cool a bit in 2011 when the RBA raised interest rates, but then proceeded to cut interest rates afterwards. As they cut the interest rates, again, it boosted the market, and in late 2014, we reached another peak, and it has since begun to fall. The reason for the recent decline is due to investors and buyers facing fatigue, as their wealth is being decimated by low interest rates and rising living costs. And with capital control in China since the middle of this year, that has also caused sales volumes to start collapsing, as they have been a major factor in propping up our prices and also our sales volumes. The reason for the average price rising is not, in this case, the time to jump in, because even if you think you're going to miss out, it is actually nothing further from the truth. In a case where you have falling sales volume but rising prices, this is better reflected by the fact that better quality properties are being sold, while those which are not as good, they're sitting there waiting in the market, and they're hoping that they'll be able to sell at a desired price. But as things turn for the worse, they may be willing to take any price that is offered, and those prices could be much lower than what they're being offered now. So the bigger picture we see is that rising living costs relative to weak income growth and property market speculation are squeezing Australian households. It is not easy to see this as the media reports these issues separately. They try to downplay the negatives and magnify the positives. But hopefully in this video, I have put these things together, and you can see that they sit together and there is a more negative yet truthful narrative. What we are seeing is the biggest building up of financial tinder for the next crisis, not just for the Sydney, but for the rest of the world, as we are creating an even bigger bubble than the one we faced in 2007. And this time, we are coming down from higher heights, and it will be hard to recover from it. Well, that's it from the Sydney Contrarian. Stay tuned for a future episode, and once again, God bless.